Good morning, ladies and gents, and welcome to the April 2025 edition of the Blackfinch 10-minute market forecast. We're pleased you can join us today. My name's Jordan, Strategic Business Development Manager for Blackfinch Asset Management, and I'm joined today by Josh Clayton, Product Specialist for our suite of listed investments. Before we begin, it's important to note the content of this webinar is intended for the professional advisory community, and so the details covered today are not intended to be taken as financial advice itself. If during today's webinar you'd like to submit a question, be our guest and do so using the Q&A box at the bottom of your screens, and we'll come back to you after the webinar to address whatever queries you might have. With which number of topics that could be covered with the goings-on in markets recently, we've chosen two subjects we'd like to cover for you today. First is the elevated levels of economic uncertainty in the US, where the US is experiencing a shift in investor sentiment driven by political changes and tariff tensions. With Trump's long-term economic focus and lack of stock market support, combined with rising inflation expectations, we've seen increased uncertainty and market volatility. So we'll be looking at this through the lenses of both the consumer and that of the Fed. Secondly is a changing fiscal narrative in Europe, with Germany appearing to be breaking from its historically conservative fiscal stance, introducing major stimulus focused on infrastructure, defence and industrial growth. We'll explore why we see this as marking a turn point and how improved growth forecasts and stable inflation expectations positions Europe, especially its equity markets, as an increasingly attractive investment opportunity. With that said, it's best I hand over to Josh to get into the detail of these topics. Morning, Josh.
Good morning, Jordan, and a very good morning, everyone. Thank you for tuning in. Now, I thought we'd start by just talking holistically about the global market, as this feeds directly into all of the key themes here on the screen. This certainly feels like there is a huge paradigm shift for investors in the US and other key regions. So on the one hand, we have Trump openly stating that his focus isn't on the stock market and instead is wanting to think way into the future, so almost decades on from now, and lay some of the structural foundations to make America great again. And for the moment, that's at the cost of the US equity market. And this directly contradicts his first term in office, where he was very supportive on US equities and boasted its performance to the press. And then on the other side of the Atlantic, we have a historic change in what some have coined as a fiscal bazooka for Germany, with a huge splurge on spending on German defense and infrastructure. There's a lot of fiscal wiggle room with access to public debt and new spending that can really kickstart the economy. And I'll come on to this on the final slide, but this really is an unheard of move for the economy. It's defied all expectations. So we've been seeing a bit of a capital shift in markets, and I'm sure you're well aware of the recent US drawdown. There's been a lot of profit taking where investors are looking to cash in, look for other opportunities, and then the view of the US economy has changed, with some citing an increase in recession risk. But the key topic is the impact of tariffs, the level of uncertainty and the volatility it creates. And this is going to be the key point here to talk about with your clients. And I'm going to come on to some of the views of our portfolios and how we can tackle it. So first, let's have a think about the consumer here on the first slide. And if you've joined us previously, I've shown this chart in a slightly different form, but this is a clear example of the impact of tariffs on the consumer's psyche. You know, what are they thinking about when they see the news and the announcements of these tariffs? Well, this is the University of Michigan survey data, and it shows the expected change in prices during the next 5 to 10 years in the US economy. So in 5 years, what are consumers thinking of in terms of inflation over the next 5 years? And the two measures here in blue show the mean survey data, which can be skewed by big outliers, and that's why it's slightly higher than the median on the right-hand side. And this really stretches back to almost the last structural inflation shock of the 80s. And just look at this massive, massive uptick in survey data since the start of the year. Consumers are thinking inflation is going to be a problem in 5 years' time. And this is an example of recency bias from our textbooks. You know, how can anyone understand the impacts of tariffs today on inflation in 5 years over the next 5 years? However, some can argue that this is a bit of a self-fulfilling prophecy, where people think it's going to be a problem now, so they buy the goods and services to avoid higher prices, but that in fact stokes demand in the short term, and then prices rise by default. But this is remarkable data here on how much it's spiked by. And if you think back, it wasn't even this high in in the inflation shock in 2022, which is case in point on the level of power Trump has on markets. But it's not just the consumer that Trump has some effect over. It's also been the Fed, which is very unheard of historically. We were having a discussion in one of our investment team meetings yesterday on politics and how much impacts it's had on markets this time around. And we typically wouldn't see this level of uncertainty on show. But if you cast your mind back to March, we had an interest rate decision from the FOMC, the Fed. The decision was to leave the Fed funds rate unchanged, which was universally expected. However, the key part of this was to watch what Jerome Powell said, and the message was very clear, and it was that things are very unclear for the economy itself. And he stated that this was due to the confusion surrounding the new administration, particularly on tariffs. And the FOMC also showed the uncertainty graphically with each of the members' latest dot plot forecasts, and this is what the chart is showing here. So it's nice and simple. It takes the highest estimate, which is represented by that white line there, and the lowest estimates in blue from the FOMC members on 2025 GDP growth, unemployment, your PCE, which is the Fed's preferred inflation measure, and your core PCE, which takes out the noisy components that would swing the headline figure. And we can see clearly that there's over a percentage point of difference in estimates between the members on the likes of GDP and inflation. And this level of dispersion between the members is not a common phenomenon. If you were to review the Fed dot plot on interest cut expectations, the committee still expects to cut twice, but the risks have moved to cutting less rather than more once again. But Powell was very smart in his address. He gave himself maximum room for maneuver, but essentially there's some admission by these central bankers to rising uncertainty and risks of stagflation while trying not to break the economy, which is a very difficult task. But for investors, it's hard to see this as a significant turning point that should bring people back to risk assets. And this is what we're seeing in markets at the moment. There is a flight to safety. We've seen the likes of like UK gilt yields fall in response and pricing rise. And this is an indicator of that uncertainty. But if we understand the picture is unclear for the US and it talks to this paradigm shift I mentioned at the start of the webinar, what other opportunities are available to us? And one is certainly the German economy. As a brief recap, we've seen a recent change in the German government who have come out the corner swinging to propose a new stimulus package. And prior to that, the economy had a self-imposed debt brake. It was written into the German constitution back in 2009, and this stopped them from accumulating considerable debt on the balance sheet. As an example, the economy has a debt to GDP ratio of about 60%, whereas the UK's is 100%. So there's certainly some wiggle room available to them. But historically, that sting from the GFC and these strict rules in place have stopped them. However, the narrative in the region is changing, and there are three key events that have contributed to this. So first is this fiscal bazooka from Germany. The second is an increased level of spending required in Europe. And finally, a potential ceasefire in Ukraine, which has seen positive steps forward recently. But for Germany, these new fiscal measures focus on infrastructure, industry and defense spending. And this is the first time in a generation that we're seeing this kind of expansionary fiscal policy from them. The improvement in the investment landscape represents a consistent boost to growth, and the higher defense spending and ceasefire will be positives to growth, but just to a slightly lesser extent. And this is what is shown on the chart here on the screen. I've cited Vanguard's recent quarterly investment outlook with their forecasts indicating a material improvement in economic growth. So moving from 0.5% to 1% in 2025 and from just under 1 to 2% in 2026. And actually, there isn't a real material forecasted increase in consumer prices, only a marginal increase of 20 basis points in 2026. More holistically, investor sentiment in the region can improve through this lower uncertainty, and a reconstruction effort in Eastern Europe can also play a factor here. But this higher growth environment is driven by that potential increase in structural deficits. And that can mean a higher terminal rate for the ECB. And when I say terminal, I mean the natural longer term interest rate interest rate applied by the central bank. The higher rates can mean that that can increase higher longer term yields, and therefore that can be a positive for the region and equities. And therefore, we remain positive on European equities and hold a relative overweight to many of our peers, and believe this position could be a key driver for returns. Also, that higher terminal rate can provide real returns above inflation, and it helpfully sets the foundation for bonds over the next decade. But also your risky assets, so like equities, they can finally pay a premium on top of pricing to attract investment. And we also do allocate to active funds in Europe that can take advantage of this trend, particularly financials that would benefit from that higher terminal rate by the ECB. So before I hand back to Jordan, very, very quick wrap up. Starting in Europe, we've become more positive on the region with structural improvements coming through the economy in the form of German fiscal spending, and we maintain a strong position in the region. But this does come with a risk on Trump and freight policies. As we've already seen over the first quarter, things can change rapidly in markets, so this is a key area of focus for us here. And on the US, uncertainty remains a key theme. We have seen sustained profit taking in the region, but again, we do still hold conviction in the US as we believe it remains compelling on an earnings basis. And some of the smaller companies in the economy have the potential to provide stronger returns. Therefore, an allocation to US smaller companies, as well as a more diversified equal weight S&P 500 tracker, can help mitigate your market and concentration risk, while still accessing those stronger returns and earnings in the region. And finally, with a potential higher terminal rate of interest in certain developed economies, we believe diversification is a key tool in the toolkit. Bonds now have a foundation to provide an attractive long-term coupon for a lower relative level of risk, and they offer an attractive level of correlation should this risk of a US recession increase. We do appreciate these are more volatile times, but these recent trends have really given investors a strong reset on asset classes. The role of bonds is firmly back in a portfolio, as well as the use of active alternative funds that can give you those uncorrelated returns. But that's everything from me. So thank you very much, and I'll pass back to Jordan for final comments.
Thank you very much, Josh. And thank you everyone for your time today. We hope you found this useful. Of course, if you do have any questions on these topics, or perhaps something we haven't covered, please reach out to us with the details on screens. We'll always be happy to help. Otherwise, from all of us here at Blackfinch, we hope you have yourself a pleasant April. The final run of the tax year end goes well for you all, and we look forward to seeing you again in the next installment forecast on the 6th of May. Bye for now.